Welcome to the Future is Borderless podcast with David Nilsson. We feature top entrepreneurs and thought leaders from around the world, those who bring a global mindset and a unique perspective to their life and business. Now, let's get started with the show.
Hey, David Nilsson here. I am the host of this podcast. You know, I started the Future is Borderless as a way to connect with business leaders from around the world who I believe embrace a borderless mindset where we can exchange ideas, cast new light on innovations, and share best practices, not just in business, but also in a personal sense, ultimately helping us to lead, to grow in a rapidly evolving world. Now, this episode is brought to you by Doxa Talent. Doxa helps businesses to source full-time, highly skilled, dedicated workers from around the world. And as a result, companies can scale faster, increase margin, and improve culture. To learn more about how Doxa can help you leverage borderless talent, go to doxatalent.com. All right, well, today is going to be a really interesting episode. I have Alan Chaffee, the CEO and founder of Turning Point, coming on. He has 25 years of experience in financial accounting, business consulting, company valuations, even corporate restructuring. He's focused his last 2 decades helping companies use financial information to drive operational improvements, manage cash flow, and increase profitability. And as the CEO of Turning Point, Alan has performed CFO duties for over 100 middle market companies with revenues scaling as high as 150 million annually. Now, before that, he held senior executive roles as a chief financial officer, a chief operating officer, and president. And then I'll just note that away from those endeavors, he runs marathons, reads voraciously, and is busy raising 3 kids. So, Alan, welcome to the Future is Borderless.
Thank you, David. Glad to be here.
All right, well, let's just jump straight in. In reviewing your site, it looks like the team at Turning Point is really focused on 3 core services, and you guys name them as capital advisory, financial advisory, or CFO services, and then talent acquisition. Just to give our listeners a baseline for what it is that you guys are actually doing, can you just share a little bit about each one of those and the outcomes that you're really trying to help each client achieve through each?
Yeah, let's start with the CFO advisory. We are outsourced controllers and outsourced CFOs, focus on a solution. So we're not a body shop. You engage us when you got something in your business, like you want to improve your cash flow, improve your profitability, improve your systems. We come in and do that. The other capital advisory is really our restructuring group. Over 50% of our business comes to us from lenders who have bank lines or debt that's in default, and we help them work that debt out. And the other one is, in both those situations, we often find ourselves with a turned around business that we want to get out of and let them go back to running it themselves. And we help place controllers and CFOs and other executive level roles in those businesses once we're done.
Got it. Okay, cool. And in the case where a bank is actually sending you a referral, somebody that needs their, some support, who are you representing in that particular case? Are you representing the bank or are you representing the client?
99% of the time, we're representing the client. So the bank calls us and said, XYZ client, trip companies the last 3 quarters are struggling to make payroll. The financials don't make sense. Would you go talk to them? And then the bank tells the client, you need to hire somebody like Turning Point or Turning Point or Turning Point. And so then the client says begrudgingly, okay, I guess we're going to hire Turning Point. And the first thing we do is we turn around and punch the bank in the nose. And they know it's coming and they get a towel ready to catch the bloody nose. And we punch them in the nose, say, stand down, let us assess the situation. And then we go to work.
Got it. So you actually giving them a little bit of relief along the way. Yes. So you got to do your job.
The bank they don't want the business to default and fail, but they want a resolution to the non-performing debt. And so they know as soon as they hire us, they're going to have to pause and wait. But we've been doing this for 20 years. So they have a relationship with us. So they say, okay, if Turning Point comes in there, we're going to get the truth. If it's good news or bad news, we're going to get the truth. And that's what they often feel like they don't get from a client who's scrambling.
Yeah. Is there a common scenario that you see, like where you go in and you look at these financials and working with these companies and you see, are there common buckets where you see challenges or common mistakes or opportunities?
Yeah, the number one common thing that we see when we go into clients that are struggling with cash flow and profitability and their debt is the lack of accurate and timely financials. So the CEO or entrepreneur or hired CEO is driving 100 miles an hour blind. And so the first thing we do is we put in daily and weekly reporting. Look, your financial statement is important, but really the only person who needs them is your bank if you're getting accurate daily and weekly information. So we start there, we progress to accurate and timely financials, and from there we begin the workout plan.
Isn't that amazing? Like, I mean, that seems like such an obvious answer, but it's so true. I mean, I've been working with startups for 20 plus years through a company I started years ago. And then of course now with the Docs of Talent, but my gut says that, most people don't invest in that part of their business until it's too late.
Yeah.
So not surprised to hear that, I guess.
Yeah. I mean, a lot of entrepreneurs in the early stages of their business, and depending on what your business is, early stage could be 0 to 10 million or 0 to 50. If you got one customer, Microsoft, you actually can go a lot longer without good systems. So they run it by their gut feel. They know what revenue is. They know what cash is. They know what costs are. They kind of know if projects are, or programs or products are profitable. But when they outgrow that gut feel and they keep going, that's when the trouble happens.
Yeah, you know what? I can appreciate that. I would consider myself more of an intuitive individual than a data oriented individual, and there's a limit to how far that will scale. So I remember even as a young entrepreneur, I made all the decisions by my gut, and eventually you have to set up dashboards and have metrics and timely financials. Otherwise, you just can't make good decisions.
Yeah, and your gut gets wrong information.
Yeah.
Right. And so then you're validating on wrong information and making even further, decisions that you probably should have had more information before you made.
Yeah, fair point. Let's talk about strategic finance, also known as sort of the CFO. My gut is that most people don't invest in that early enough, right? They don't believe they're going to get the value up front, and then by the time they realize they need it, it's tough to maximize it because they're so behind on that, timely financials that you're talking about. Like, help me understand, like, when is the right time for someone to start to think about investing in strategic finance? I'm not talking about accounting, right? Just like the CFO type.
My answer is from the beginning, but you want to buy slivers of it, right? So we need an accurate strategic plan. Let's say we're launching our business, we're buying a business. On day one, I need a well thought through driver-based financial model tied to operational initiatives that break down into metrics that I can measure on a weekly basis. Are we doing what we said we're going to do? Right. So I'd say on day one, now most businesses don't do that, right? The entrepreneur is whatever their specialty is, revenue engineering, sales engineering, whatever their specialty is, software development, and they don't do that. But if I was advising a group of early stage entrepreneurs or at a university, I'd say start buying slivers of it in the beginning, right? Because buy what you need. Outside of that advice, I'd say when strategic planning becomes a critical part of your business, right, is when you need to hire those people, or if you need a bank line, right, because banks aren't strategic, and so knowing how to navigate that is usually the first entry point in startup companies for us. Is when they're talking to their lender, and the lender says, "I can't understand these financials, and how much do you need?" and and stuff like that. Start asking questions about personal guarantees and bank covenants, foreign language to a lot of entrepreneurs, and so that'd be the other entry point.
Yeah, help me understand though, when you say buying slivers, like what are some of the options that people have to buy a sliver of a CFO?
Right. How much equity should we raise? What's the operational plan, and how does that relate to the financial and cash flow plan? When are we bankable, so we can then begin to leverage working capital into to finance the gap between receivables and paying payroll. Collecting from your customers and paying payroll. You collect from your customers on average 38 days sales outstanding, and you make payroll every 2 weeks. Well, that gap on a growing business causes a lot of pain. Looking at long-term customer relationships, pricing products or services, those are when you want to begin to bring in somebody who's forward-looking and has enough experience to connect the dots between operations and finance.
Yeah. But, one of the things that's funny, we're obviously, we work with people all the time to help them find talent, and finance is actually one of the big sort of niches that we serve. But I think there's often a lot of confusion between a CFO and a controller. I think people are using that interchangeably. So could you is there a way that you could just break that down, distill down, what is the difference between what a CFO does and a controller does?
Primarily, the line could be a little blurry in the middle, but primarily your controller is backward looking. They're reconciling transactions and the trial balance and producing financials that tell you what happened. They're managing AR, AP, maybe payroll to capture the transactions that go to the debits and credits, that create the trial balance, that create the financials. Your CFO is taking those financial statements aligned with the strategy and telling the leadership team, here's what I think is going to happen tomorrow financially.
Mhm.
right? That's what you need. You get in that bridge, that finance, that gap from high individual contributor, controller reconciling the books and make sure transactions are all in and cutoffs are right. And it's according to the gap to looking forward and say, in my crystal ball, it says, here's what's going on microeconomically, macroeconomically. Here's what's going on in our business with our two key customers. Say, okay, here's what this means for tomorrow. That's the CFO. They're telling you where you're going. We call that shaping the future at Turning Point. And your controller is looking backward, saying, this is where we've been.
Have you ever seen a scenario where the controller is able to sort of make that flip from looking backwards and actually starting to step up into the role of CFO and sort of, making that shift?
We specialize in that, David. We at Turning Point, one of our core values is we make great CFOs, but it is so painful to watch that transition because the value of a really good controller is accuracy, timeliness, volume of transactions. You watch them, they're flying on the keyboard, booking entries, reconciling Excel. They're always Excel geniuses. And we say, okay, stop that. Now look at those financials, look at the forecast, look what's going on in the industry and in our business in particular, and tell me what's going to happen next quarter. And they have no sense of value. Like, how do I know what's going to happen? I can tell you what happened. So we watch it all the time, and it takes almost a year of an out-of-body experience for them. And then they never want to go back. They never want to go back to the world in which they're buried in transactions to a world which we're sitting with the leadership team projecting or shaping the future of the business.
Yeah, it's interesting. It's like a total different shift to go from like precision to reasonable guesses.
Yeah, and a lot of people go into accounting because they like the precision of it, right? And one of the things about precision is it's safe, right? I don't have to worry about being wrong because look, these debits and credits added up. Now, maybe somebody entered it wrong and somebody in inventory entered 20 instead of 2 of widgets on the floor, but I reconciled to what they entered. It's right from my end. I have to tell you what's going to happen tomorrow, and no matter what I tell you, it's going to be wrong.
Yeah.
So it feels very unsafe to accountants to project the future.
Yeah. I want to just continue on the line with the CFO. So it's actually not uncommon that I talk to people who don't even have a line of credit established. They haven't really even thought about, I should probably have the ability to access capital even when I don't need it. Right. Walk me through sort of when you guys think about helping someone, start to wrap their brain around a capital strategy just for operating purpose. What are some of the things that they need to be thinking about or that you guys help them do to get prepared for that time?
We look at the working capital shortfall due to growth, or if it's a seasonal business planning for, fourth quarter. A lot of, retail style businesses have a busy fourth quarter and they spend first 3 quarters ramping up to, 75% of their revenue. So we look at that working capital gap, and then we look at collateral. So collateral is what the bank will use to underwrite the loan. An example would be 80% of what's called a good accounts receivable. Accounts receivable under 60 days that don't have more than 25% outstanding over 60 days. So inventory, maybe 25% or 50% of inventory up to a cap. So we look at what's available for collateral, what the working capital gap is. Do I need $1 million or $2 million or 500,000? And do I have the cash flow to repay that per the bank's calculation? It's called fixed charge coverage. And so we map those. Say, okay, you're very profitable, so your fixed charge coverage is good. You have $1 million in AR and you have no inventory, service business. We can then get $800,000 in a line of credit for you. How much do you need? Because if it's not enough, then we have to get more creative. If you only need 500,000, then let's borrow 500 because banks charge unused line fee often. So if you can get 8, but you need 5, you're going to pay for that 300,000 you don't need. So let's not do that, right? So that's how we map that.
Fascinating to me. So there's one use case makes total sense. Growing up, my father actually owned a large fresh Christmas tree company. They had international distribution actually, and so I remember like they basically used their line of credit to survive for 3 quarters, and then Christmas would come and they'd sell ton of Christmas trees, pay that back, and basically earn all of their money for that year. So that use case is super simple, one that I can clearly identify. The thing I've always found interesting about the collateral is that if you're really efficient at collecting from your customers, you don't really have a lot of AR that can actually hurt you when it comes to getting a bank loan.
There's
Have you seen ways that people? Oh, I was just saying, have you seen people overcome that?
Yeah. So it's two scenarios I can share with you. If you're making payroll every 2 weeks and your customers pay you on the dime at 30 days, then you still got a 14-day or 15-day gap. So you should look to bankroll that. I've heard entrepreneurs say, well, I don't like banks, so I don't want to borrow. I'll just take it out of my cash flow. My answer is no, you should leverage your assets. It's a better way to grow your business. And we can talk about that. The second one is, this is a big one for e-commerce companies. They get paid on a credit card the minute the order is taken. We have a $60 million e-commerce company, does home goods. They have no AR. Banking them, and they have lots of inventory, $10 million in inventory. Banks don't like inventory because they're not in the process of selling product. They don't want to do that. And in a liquidation, product often goes for 30 cents on the dollar. So very hard to bank them. They're very profitable. They're 60 million in sales. They're growing 25% a year. They have a great customer base, good traffic on their site. Hard to bank them because banks go, well, there's no AR. What do we do? Yeah. Now we're able to find it. There is a growing group of lenders. One's called Republic, who will lean into inventory, but it's still not at 80%. It might be at 50%.
Yeah. Yeah. I've known this to be a real challenge, but it's nice to see that there's some other alternatives starting to spring up.
And that's where your CFO can say, okay, we need to go out and raise capital or find some other alternative financing means to bridge that gap from 50% to 80% if we're creating sales on AR. Now, normally you would think collecting cash today versus 30 days now would be better, but it's hard to leverage that into a bank line.
Yeah. Yeah. It makes total sense. It's funny. We talked about this a little bit, that my business Doxa helps people fill positions from software engineers to sales development, even marketing automation. But what's funny is that when we started this business, I didn't anticipate this, but finance, meaning accounting, bookkeeping, CPAs, AR, those types of roles have become our biggest demand channel, basically. I was a little bit surprised by that. So I guess my question is, why is there such a shortage, or at least such an acute need for that type of talent for these different companies? Why is it so hard to find people that do that?
Accounting is you have to learn it, and it takes a long time, right? I don't know, very few people who took accounting in college and said, "Oh, that was intuitive." The gap is not intuitive for the most part. So there's one that is that it's hard to take somebody off the street and put them in a 60-day program and have them be accountants. That's not impossible, but it's hard. I've had people ace the QuickBooks 90-day training program and still can't book a journal entry, right? They don't know what that is. So the bigger issue that we talked a little bit about is the accounting world hasn't done itself any favors. The first thing they did, and I don't know, maybe 20 years ago, they added a 5th year requirement to become a CPA. And the CPA is the standard route to go from auditor to controller to CFO. And so they added a 5th year, which is really ridiculous because it's not an MBA and it does nothing for you, right? So I know it's very frustrating. I have to go to school for another whole year and I get nothing more than a master's in accounting, which doesn't mean anything, right? That's my opinion. Sorry, some people may think it means a lot if they did it. I don't want to get in trouble. But it's hard. They should have either left it as a 4-year program or moved it to an MBA program, right? Because then it's worth the extra effort. The next thing they did, they followed that shortly by breaking the CPA exam into 4 sections. So it used to be when I took the exam, I studied for a year, and then I took a week off before the exam, and then I went for 3 days in a row and I took all the tests and I'm done. And you walk out sick to your stomach and dizzy, but you did it. Yeah. I think they had below 50% pass rate, first pass, but then you can go back and take whatever section again that you failed in 6 months. So they now broken into where you take one section at a time, and you have to take them all within a year, or you start over.
Oh wow!
So that's a big shift. I got to go to school for 5 years. And now I have to, and by the way, in that 5th year, there's no new information. It's the same program, just spread out further. Now I have to study for a year to take all these tests, and I have to take them one at a time. And you can take them like almost every month. So it's not like they're before it was twice a year. They've got them in proctoring stations. And so now I got to spend a year taking these tests. And if I get sick or I want to take a vacation and I miss that, I got to start over if I don't get them done in a year, right? So, or at least the first one drops off is how it works. So, and then accounting firms have always, because it's 2 years work to get your CPA done, indentured, the big firms, indentured servitude, right? So you don't make much and you work insane amount of hours, tick and tying source documents to transactions. And they don't pay a lot. So now, it's 2015. I'm out of school. I'm coming up on my school, and I look another year, and I've got my degree in finance. And Amazon's going to offer me, 1.2x what Deloitte's going to offer me. I have to go to school for another 4 years, and then I have to sit that test. And I don't really want to be an auditor my whole life. I really want to go into business. The choices are predominantly the best and the brightest are moving to Amazon, Microsoft, even smaller middle market companies who are paying more and offering a direct path to leadership, versus 2 years indentured servitude, another year of school, a year of testing, 2 years of indentured servitude, and then I can start my career. So it hasn't done a good job of bringing the best and brightest to it. Now, there's still brilliant people in finance and accounting for sure, but it's just not enough of them.
Yeah, there definitely seems to be a shortage. And I think some of the changes you talk about there certainly makes sense why we're starting to see that shift. I remember years ago reading that there were more CPAs that were retiring than actually being certified, right? And so the 5-year shift makes a lot of sense. Alan, I want to just shift for a second, talk a little bit about the macroeconomic climate and sort of what you're advising your clients on, because there's this sort of, I don't know if it's a real trend, but I guess it's purely anecdotal, which means it's not a trend, but because I'm an intuitive guy, I'm just going to say it is. Most of my conversations with entrepreneurs these days seem to sort of have this same sort of thread, which is during the pandemic, I did really, really well. But now that it's over, I'm struggling. And it feels like we are heading into a recession. Some believe we're already there. But what are you seeing and what are you advising on your clients, or advising your clients on, I should say, sort of anticipation of what I would call, for lack of a better metaphor, a colder winter? Like, what are you telling people to do today?
The biggest thing we're a firm believer in, or I'm a firm believer in, reforecasting your forecast every quarter. So we everyone does an annual budget planning process. It's an important process. It should connect the divisions of your business to each other, to the CEO's plan for expansion or growth. And then everybody breaks that into actions, and you break that into budgets, and then those budgets become, the plan for the next year. But whatever we do in October, November, December, the prior year, by March, April, May is no longer true by fact, right? It's going to be different. I don't know, 20 years ago when I was doing budgeting for a living, I don't know if that was as true then as it is now. We live in such a more dynamic world that we're in. Things are changing all the time so rapidly. So what one is every quarter, a reforecast. And that doesn't have to be a deep dive as your annual budget, but a reforecast. And then constantly be looking, there's a book out there, the Lean Startup. Oh, yeah. So constantly always thinking lean, and tying where you're spending money to the strategic initiatives of the company. Now, again, that makes like, oh, of course, that's just common sense. But how many people say, well, last year marketing was 1.2 million, so we're going to make it 1.3 this year. And my answer is, wait, what are you spending out on marketing, and why? And what are the initiatives? What do you achieve? What do you hope to get out of that, right? Is it click-throughs or new customers or new, whatever it might be? But really starting almost like the old school zero-based budgeting, which is out the window now. But I think about it like that. Like, we're not going to spend $1 million next year because we spent it this year. What are we going to spend it on? Is it the right amount? And doing that almost every quarter, and coming back to what we were supposed to achieve in that quarter, non-financial goals, and did we get there?
Yeah, I love that. I think that's really great. In fact, we'll put this in the show notes. I love the reforecast every quarter, follow the trends, those turn into actions, those build budgets like that. That to me is actually really insightful, because as we go into a recession, the trends change. What we've seen for the last 10 or 11 years, we've been in a bull market cycle. And of course, the pandemic shifted that. But people keep saying, I can't wait till we go back to the norm. I don't know if that even exists anymore. So rebudgeting gives us a chance to sort of learn the business over again.
Right. Gets everyone to go back and start with non-financial metrics, connect it to the financial metrics, then look at the financial metrics. Are they the right ones? We had 78 billion clients last month. About 25% are e-commerce. All of them did great during COVID. And so what did they do? Most of them rented new warehouses on an opposite coast where they're at. They filled them full of product. They couldn't get products. They went from just in time to just in case. And all of them are down 40, 50, 60% right now than over 2021 at the same time frame. And that's an example where if they were, and look, Amazon did it too. Amazon's retracting, Target's dumping inventory, Walmart's dumping inventory. Some of the best logistic companies in the world did the same thing. A lot of our customers did, but that's where if they were doing this in Q1, they would have seen the fall off. And instead of being optimistic, right, what most of them did, they went to spend more marketing dollars. Let's get more customers. Let's get more eyeballs. Let's get more click-throughs. And it didn't work because people left their houses and left their laptop behind.
Yeah, that's awesome. It's funny. I do. I know a lot of people that upgraded their office space, spent more on equipment. I love the just in time to just in case. I did see that a lot. I talked about the anecdotal trends that I'm hearing as I've been talking to entrepreneurs, but given that capital advisory is a big part of your business, are you seeing that impact in your own number of referrals coming from lenders, or because rising interest rates means that the cost of carrying of debt is going higher? Are you seeing the same sort of trend from a financial perspective?
Yes, we've gotten more weekly referrals right now, 2 or 3 a week from lenders. It hasn't been this busy since 2014. 2010 to 2014, the phone just rang and rang and rang, right? All the loss sharing agreements with all the banks that were failing, all the bad debt was out there. Our phone just rang. We just stopped answering, right? They'd have to find us at the coffee shop. They want us to take their project. And now it's starting again. During the COVID, banks had they didn't have to treat debts that were risk rated. Risk rated means they're in default at some level. Some minor default can be big default. They have to risk rate them and then work out the recovery plan. That's part of the FDIC's rules, right? During 12/31/2020 and 12/31/2021, up until then, they didn't have to do anything. They wanted you to look at them as a lender. They wanted you to risk rate them, but they didn't require you to do a TDR or a total debt restructuring, which is what they're supposed to do. So and then of course, nobody really had any issues because they got PPP1, PPP2, ERC, Main Street, EIDL. EIDL went from 250 to 250 to 500 to 2 million, right? And so they just flush with cash, but that cash is gone. Banks can't pass anymore. And so they're all right now scrubbing their balance sheets, looking at their borrowers and wondering how we work ourselves out of this.
Yeah, I think that's right. I think so much stimulus was available that it sort of buried a lot of operational sort of inefficiencies and even risk at that time. So
this is a statistic I made up, and I don't know that it's factual, but I generally think about 30% of businesses aren't fiscally sound. That's just my experience with 25 years of doing restructure work. And so that didn't change during the pandemic. It's got masked over with all this cash flow. So that cash flow's all back out to sea. Those companies are still there, and there's no more money for them.
Yeah. Be interesting to see what comes, but I think I love the reforecast every quarter, and I think what you were saying is to stay away from just in case, but actually go back to just in time, right? Yeah. Let's talk about you personally. I'm just curious, how have you evolved as a business person over the last, call it 3 to 5 years? I mean, all of us are trying to learn and grow, but how have you sort of shifted your leadership style as the world continues to shift?
Well, thank you for asking that question. As you know, it's a leading question because I've changed tremendously. I appreciate the opportunity to talk about that. For 18 years that I ran this business, I ran it as chief consultant to my clients with a handful of really cool people working for me, doing great projects. Even though we're CFOs, we're almost always restructuring CFOs in that time frame. And so I got to choose who my clients were and choose the 10 or 11 staff I had around me. And it was a wild ride, and I learned a lot. But I never grew the business, and it was always cash strapped because however much money I took home, I spent that. So we needed more. And so I had at the end of 2018, the best staff I'd ever had. But they have careers, and this is the third time this happened where my staff grow up. They're really good, but there's no career path at Turning Point because it's me and my hand selected of married women who did good things. So we decided to grow the business. So I stopped being consultant to my clients. Started running my own company for the first time. And as David knows, I talked about doing that for like 17 of those 18 years that I didn't do it. But I started doing it, and it's been miraculous. We're at 36 people today. They're all fantastic. I don't do any direct client work. I manage my team. I actually have one-on-ones with them. I do things like CEOs are supposed to do. We actually do our own planning session we never did before, because why bother with the budget? It's just me. It's really worked out well. Today we have 5 owners in the business. I was the only owner for 18 years, and they're all awesome, and the business is growing, and our reputation is growing. It's been life changing for me personally to watch this happen. And the last piece of that is I had the first year, I didn't know what to do, because every time I love client work. I love it so much, and I couldn't do it. And I didn't really know what I was supposed to do with all these people now we were hiring. So I didn't do anything with them either. So I sat in my office and watched my hands. It's like, well, okay, now, but today it's, I'll never go back to what we were doing. And it's been pure fun and exhilarating to watch the practice grow.
I'm curious though. So yeah, I'm glad you were able to share that, because I do know that that's a transition you've made recently. But was there a moment, because you said it a minute ago, I've thought about this for 17 out of 18 years. And I do think most entrepreneurs, including myself, we love working with the clients. We're really good at it. So we want to hold on to that. It's hard to let go of. Like, there's all those sort of moments. But like, what was the moment that you finally said, okay, it's time? Like, what happened?
I looked at the staff I had, and I knew they're going to leave. And I didn't want to do it again. The first time I turned over the staff, and it doesn't happen on a day, but over 2 or 3 years, my best and brightest move on to great jobs. We have like 18 right now, ex-CFO or ex-Turning Point people who are CFOs in the Seattle market. And we're proud of them. We have little placards for them, right? We celebrate them. So I didn't want to lose these guys. So I had no choice. And by the way, I think I turned 55. I was kind of tired. So, I wasn't learning as much. Part of the joy of doing the work that I did for all those years is every new client brought a new learning experience. And I still was learning, but not at the pace I was before. And so it was I think it really was just time to do it. And I was so proud of the staff that we had, and I didn't want to lose them.
Well, necessity is the mother of invention. So, it's funny. I actually was, I relate to the story that you had when you're like staring at your hands for, yeah. I remember I'd hired a coach at one point, and he sort of helped me put a system in place in the business. And I realized that the more authority and autonomy we pushed into the business, the less I was needed for. And I remember I said to him one time, I said, if I do this though, like, what am I going to do? And he said, go get a hobby. like go do something with your time that, matters for you. And I realized at that moment, yeah, you're right. I mean, being a good leader doesn't mean that I have to do the work all the time. Right. So I thought it was an interesting moment.
It is a journey. I let go of everything, and I asked open-ended questions versus I built my life telling people what to do. Right. Yeah. It doesn't work. You don't empower people doing that. And I coach CEOs to empower their people, but I didn't follow the reasoning myself. Just this week, we had a big restructuring project come up in Anaheim, California, and I jumped into old school mode, and I grabbed a staff here and I grabbed a staff there, and I, booked their airfare, and then we're going to Disneyland to do this big steel restructure. And then I forgot there's a director of restructuring. I should have been doing that. Right. And so it's still a journey, but I had to go apologize. So, and I was happy to do that, both because I didn't like to apologize and I have to learn my lesson, but I felt bad for slipping backwards, even after, doing this since 2019.
I think we're all guilty of that. I think anybody who has an entrepreneur that's listening to this will say, like, we love solving problems. And when you see these new juicy ones, it's hard not to jump into that mode. Right. So I get it.
Cool job, and I want to be a part of it. And here we go again. And then I'm like, oh, wait a minute. That's not my job anymore.
Yeah, totally. All right. I want to talk just for a second about actually Turning Point. You announced, I don't know, about a half a year ago, that you guys took on a significant investment. And after being in business for so long, it's not super common that someone would then raise capital, right? So I'm just curious, like, why was right now the right time for you to make or to take on an investment?
Here's what happened. We were growing, and so I'd hire 6 staff. And in our world, we're pretty controlling on how there might be lots of ways to do a certain type of project, but I know our way works. And so we have all these training videos you have to watch, and we have quality control, and we have tests. And so, and it goes all the way from how do we build our work papers to closing a set of financials to how do we build a forecast? So how do we manage the lenders, and how do we tell the CEO entrepreneur what's going on in their business? So it takes a while before they're fully billable. as you can imagine, our AR is like 32 days, pretty good, but I'm paying payroll and I'm adding expenses. These are 5 and 7 year accountants, so they're expensive. I'd hire 6 and I'd pause and get them billable and get cash flow going again, hire 6, pause. I hated that. I want to go. So the primary reason, we got an unsolicited call from the East Coast from a large national consulting firm wanted to buy us. They gave us a LOI. I was like, what? They're going to do okay. And I shared it with a local family office here, looking for advice. And they're like, oh, we'll beat that. We'll do it. And we'll give you a couple million, $2 million in growth capital, low interest rate, line of credit, no questions asked. And so that's what drove it. It was simply kind of opportunistic on our part. And 2, it solves the cash flow problem. So now I don't worry about it. What I worry about is finding the exact right people to get on the bus. Right. Before I like, oh, that's a really good person, but I can't hire them until 3 months from now. Now I can just hire them.
Now you can just hire them, but you can make sure you get the right people.
Right.
Yeah. Super cool. Well, I know we're getting towards the end of the show here. I guess last question for you is really just, what are you most excited about today? Like what's driving you at this point? Actually
playing real CEO. After coaching CEOs for 20 years, get to do it myself. I'm super excited every day. I just released a newsletter out, but I used to, when we come into restructuring companies, here's what I would do. Like we would assess the situation, and somebody'd say to me, well, CEO would say, we have this great culture here. And I would swear, like use 4-letter words. Who cares about culture when you can't make payroll? Slip their necks, pitch them out the window. Let's go. We got to cut costs. We got to find new customers. We got to punch the bank in the nose. We got to do all these things, right? I couldn't have been more wrong. When we go into a restructure now, the first thing I say is don't forget about culture. Let's make sure that the people in that company have a common set of aligned core values before we start to go in there and do our craft or practice our craft, right? Whatever that might be. And so today, running Turning Point and having this great culture that we have is the number one thing that gets me up every day.
Love it. Well, let's leave it there. We've been talking to Alan Chaffee, the CEO of Turning Point Strategic Advisors. Alan, where can people learn more about what you do? Turning-point.com. Turning-point.com. We'll put that in the show notes. Alan, thanks for being on the show.
David, thank you for having me. It was great fun. Talk to you soon.
Thank you for listening to the Future is Borderless podcast with David Nilsson. Be sure to click subscribe to future episodes so you can hear from more top entrepreneurs and thought leaders. And we'll see you again next time.